Have you ever driven past a parking lot and wondered who actually owns it and how much money it actually makes? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're talking to Kevin Bupp, a seasoned investor best known for mobile home parks. But today, we're going to be exploring an asset class most LPs overlook: parking. Kevin shares why parking lots might offer better margins, lower hassle, and more stability than you'd expect, plus how they compare to his bread and butter strategy of mobile home parks. Well over 100 million in acquisitions. And with that, I am excited to dive in. Welcome, Kevin.
Pascal, thanks for having me, man. Excited to be here.
Yeah. So look, I want to get into parking and kind of this unique asset class that you've been investing in for over 5 years, but you originally got your start doing mobile home parks, which I think you've been doing for 10 or 15 years. I'd love to take a step back and get an idea of, let the audience get an idea of how did you get started in real estate and how did you get to where you are today?
Yeah, no, great question. And it goes farther back than that. Mobile home parks are just, I guess one of the steps in the journey. But, backing up to age of 19, I was went to high school, graduated, did not go away to school like a lot of my friends. And I just wasn't all that academically driven. I kind of got through high school by the skin of my teeth, just did the bare minimum, only because I didn't know necessarily where, what I was learning was going to be applicable, my adult life. And so no one ever gave me that guidance. And so I just did what I needed to get by. And then graduated, went to community college, just kind of, just rolling through the motions with no real clear guidance. Knew I wanted to do something big. I was always an entrepreneur as a kid. I had a paper out at the age of 12. I used to go shovel snow, mow grass. I learned how to learn electronics at a young age, installed car stereo systems in my brother and his friends' cars in our garage. Just was always trying to make a buck. We didn't grow up rich and we didn't have a lot, but never went without. Right. And so I just tried to make my own money. I wanted to buy the latest and greatest, sports equipment, BMX bikes, dirt bikes, things like that are important to kids of that age. But so I was always trying to make money. I always wanted to make my own way. But when I graduated high school, I didn't really have the direction of what that really looked like. I just knew that college probably wasn't like, more formal university wasn't really in the cards for me. And I also felt as though if I did do that, I would probably just, flunk out, in the first semester for partying or something like that. Right. And so I just at least had some self-awareness that probably wasn't the right path for me. And so in Pennsylvania, where I grew up, you only had to be 18 to 10 bar. And so I took someone's advice and I went and got a job bartending at the age of 18, going to community college. So was making really good money, working 3 nights a week, just having fun, kind of rolling through the motion. But again, no clear direction and kind of wanting something bigger. And so I was always kind of keep my ears open, keep my eyes open. And at the age of 19, I ended up meeting who became my first mentor. His name was David. And I met David through a girl I was dating. Her mother was recently divorced, was on the dating scene, and she started dating this guy, David, and David happened to be a local real estate investor. And so through various interactions of visiting her at her mother's house, I got to know David. He was over there visiting quite often and got to understand who he was, what he did, generally speaking. And the biggest thing to me that was just eye-opening was he was an entrepreneur. He's a business owner, which my parents, we didn't have any immediate friends. I didn't have any family members that were business owners. Both my parents worked full-time jobs, and the word entrepreneur definitely wasn't part of our dialect. And so the thing that stuck out to me about David was he just drove a very different car than what I was used to growing, like our parents drove growing up. He had a different swagger. It just seemed to be around during daytime hours when I thought a lot of old folks should be working, right? Like the 9 to 5. And that was intriguing to me. And fast forward a couple of months of getting to know David, I don't know what he saw. We've never had this conversation. I've always meant to go back and kind of ask him, like, what was the reasoning that you ultimately invited me to? He invited me to a 3-day conference in Philadelphia, and just his business partner couldn't go. He said, "Hey, here's what I do. I know you don't necessarily understand it, but I own real estate. I have rental properties. My tenants pay me, rent. That pays down the mortgage. I make cash flow on each one of those units, and that's what supports my lifestyle. This is the conference in Philadelphia. I'm going to. I've already paid for it. Would you like to come? I've got an extra ticket." And I said, "Absolutely, yes. I'll join you." But I don't know the reason that he really, went out, he extended the olive branch and made that opportunity for me. And so I took advantage of it. And that was the start of it, Pascal. Went to his conference, met a lot of people that were, in my mind, incredibly successful, making a lot of money. It was overwhelming. I didn't know what the hell they were doing, how they were doing it. I just knew that the one thing I took away from that conference was there was a whole room full of people, probably a few hundred people, and I didn't feel like they were any smarter than me. They just knew a little bit more than what I did at that point in time. And so I came back not wanting to lose the steam that I'd gained, and I made David an offer he couldn't refuse, and that was essentially I went to work for him for free. He was a solopreneur, didn't even have an assistant, kind of did everything right, and he did it good, just didn't do it great. There's some things that he thrived at, and other things he sucked at. Like technology was not his strong suit. Even returning emails was not his strong suit, right? And he was just disorganized in that area. Just mostly, I think, due to age, right? There was like a 25-year age gap, right? And technology just wasn't a thing. And he didn't want to adopt, right? He didn't want to be a part of it. And so anyway, he accepted the offer. I ended up working for him. So for 14 months in between classes and basically outside of my bartending hours, which were evenings anyway, I spent time at his home office out in the field, listened to phone calls, what he said, who he said it to, why he said it, right? How he said it. And just through osmosis, just being around him, I was able to just learn a ton, also make connections that he had spent years, decades building, like his network, met a lot of those connections. And at the age of 20, was able to finally, get comfortable enough, take a little bit of the money I'd save bartending and the knowledge I'd gained. And I went and bought the first single family home. And that was the start of it. That kicked it all off. And fast forward from that point, I was 20 then. And I really I'd say I really hit a stride at the age of 22. I met another mentor that just had a big scale operation. And I've always learned to kind of, don't fix what isn't broken. Don't reinvent wheels. Just find others that are really successful at a particular business model and just replicate it, right? Like you might put your own little spin on it, but like, don't try to completely change what's obviously worked for a long time. And so at the age of 22 is when I really hit the gas, and I had moved down to Florida at that point, here in the Tampa Bay area, which is where I live today with my wife and two boys. But from like the age of 22 to the age of like 27, I ended up acquiring about 125 single family homes, wholesaling or flipping a ton of others. But like as far as like a rental portfolio, 125 single family homes, and then a few hundred apartment doors, and then some other miscellaneous commercial real estate. So that was kind of like I call it like there was like two phases of my journey. The first phase was everything leading up to '08. And then '08 was incredibly challenging. Lost pretty much everything, had to start all over again. That took about 3 years of just damage control, managing all that. And then in 2011 is when I really started phase two of the journey. And phase two is where mobile home parks came into the story. Mobile home parks had never been a consideration for me. I never looked at the asset class. I just happened to meet a guy that owned a few mobile home parks. And my conversation with him intrigued me enough. It got me excited because I didn't know anyone else that owned them. And he made it just seem like, the best thing since sliced bread, way better than multifamily, way better than single family, whatever. He was like, you got to go buy one. It's great. The returns are phenomenal. And I did. I took his advice. It took me about a year to go buy the first one. And that was back now in 2012 when I bought that first mobile home park up in Atlanta, incredibly distressed, big turnaround. And now, we've gone full cycle on, we typically buy and hold, but we've gone full cycle on about 20 mobile home parks now. And currently have a portfolio of about, I think we're at 27 communities, about 4,000 sites in various different states in the Northeast and Southeast. And it's been a fun ride. So we love the asset class. It was very secretive back then. Not a lot of folks knew about it. Now that's not so much the case. Now it's kind of the flavor of the year, maybe the decade. But that's it. So we've been doing mobile home parks now since 2012. And as you had mentioned, started buying parking about 5 years ago. So those are our two verticals. We stay in our lane. Those are the only two things that we do, and we do them incredibly well.
I love hearing that. As a sidebar, I had the exact same kind of story of where I worked for so many successful people for free, and they taught me basically everything that they knew and set the direction of my life. Like, sidebar to anyone who's, I wish I could go back to my younger self and tell myself to do more of that. I think that was awesome that you did that too. You now have a big firm. Can you talk about the size of Sunrise Capital Sunrise Capital Investors?
Yeah, I mean, so we've got two different arms of the company. One is Sunrise Capital Investors, which is the, investment company, it's where we raise capital. We've got a team of executives on that side of the house. We handle all the, back end finance and all that. And then we have a property management company, and that property management company basically oversees the day-to-day operations of all the mobile home communities that we own. We do have a part of the parking operations in-house, for the most part, asset management. And then we work with national operators. There's lots of very prominent operators in the parking space that have big technology platforms. So that we do not have completely vertically integrated. So I guess in our property management side, I don't even know the exact number because it really boils all the way down from like director of operations to regional presidents to we've got project management teams, infrastructure teams, all the way down to community level managers, maintenance crews, groundskeepers, things like that. But I think it's in the 70s, I would have to guess, without looking, probably 70 or 80 maybe personnel on the property management side. And then on our on our executive team, Sunrise Capital Investors, I think we're probably in the realm of like 20 individuals. And that factors in investor relations team, our CFO, our COO, asset manager, myself, the other principal, and then a lot of support help as well, executive assistants and things of that nature. So I think all in all, probably somewhere between 80 and 90 folks within the organization. I wish I had an exact number for you. I just don't. We've made a lot, like literally the last 2 years, we've been hiring a ton. And actually, I've lost track on a number of occasions. Unless I knew ahead of time to give you get that number ready, I don't know exactly what it is.
Yeah, I think it's fine. I think just general, it's like, okay, and you mentioned that you've gone full cycle on 15 mobile home parks. So maybe walk through like how big, you've exited 15. How big is the portfolio today? I know you just launched Fund 4. Maybe talk about like the types of things that you're doing today or the opportunities you have open before we dive in.
Yes. So we've gone full cycle on 20 mobile home parks over the years. And most of those have, we've always been buy and hold for the most part and just doing recaps throughout. And we made some pivotal changes probably like 5 years ago. And so we went through a period where we were cycling through some maybe legacy assets, just kind of pruning out the tree. And, but everything we look at it through the lens today. And while it's impossible to hold everything. It just is. It's a very difficult business model to hold everything and never have to sell. In fact, I don't think we'd be where we're at today if we didn't sell some prime assets. There's some certain regrets I have of selling a number of the assets. I'm like, man, if I would have just held that for another, time does incredible things to real estate, right? Even if I had maximized the value 4 years ago, the things I sold 4 years ago are probably worth 40% more today, right? And so, but we also wouldn't have had a big cash infusions to be able to continue to grow the organization, hire, key leadership roles to help us really compound our growth. Today, we've got about 4,000 lots actively under management on the mobile home park side. That consists of, I think that's 22 mobile home parks or 23 mobile home parks is what that's made up of. And then from a value perspective, I think it's about 250 million of assets on the mobile home park side. And then on the parking side, we've got about 150 million of assets under management, and it's spread throughout the Northeast, Southeast. And then we do have one parking asset way out in Phoenix, which is like our only piece of property that's that far out west. So, all in all, 400 million, give or take, of assets under management. We're kicking off the year pretty strong. We just literally yesterday, as of this recording, which is, May 22nd, yesterday, we just closed an amazing, phenomenal garage in historic Philadelphia. Incredible asset. We like to call the parking stuff, it's irreplaceable real estate. Like literally in areas that we buy, you would not be able to rebuild a garage for the price. We're basically buying it for below replacement cost. But on top of that, a lot of these markets have put moratoriums on new parking structures being built, dedicated parking structures being built. And on, even on top of that, a lot of these cities that we buy in, the parking minimum requirements have been removed from developers, meaning that any new developments that go in, they're not building any excess parking. In fact, they're building just the bare minimum that they might need for whatever their purpose is. And so lots of parking supply is actually being constrained. It's shrinking in these different areas. So just super excited about that opportunity and that asset class. And just it's very fragmented. What attracted us to us originally is as we dug deeper into that asset class, we realized that, what attracted us to mobile home parks, roughly 15 years ago, just fragmented nature, mom and pop ownership, lack of advanced operations, lack of instituting technology, lots of technology that you can leverage nowadays that helps with pricing, supply demand, factors, what's going on in the marketplace. And we saw that same opportunity in parking. And so that's what really excites us about it. We can buy things in phenomenally irreplaceable locations, core assets, but that have some type of value add component, right? They're still being mismanaged. There's still runway to, improve upon the value, increase, the revenues, increase the NOI, and make a lot of money doing so. And on top of that, again, it's a fragmented ownership. There's not many big parking groups throughout the country. There's surely a number of groups, big institutional groups that have office properties. Then there might be parking associated with it. And so just by default, they own parking, but there's very few parking outfits that solely focus on parking and have a big holdings in the parking sector.
I would love to like double click on that. Like let's dive into to parking as an asset class. Can you take a
Yeah,
second and zoom out and kind of give us an understanding if you know this, I'm kind of shooting from the hip here, but maybe like how large is this niche? Are there like
that's
50,000
tough.
parking
Yeah.
garages around the country? What do the economics look like? I know that from listening to other podcasts, you've mentioned that there are a lot of unique traits about the way you go about
Mm.
buying certain mobile home parks that are not mobile parking garages that you expect to maybe redevelop at some point later. But let's zoom out and how do you look at that niche in general? Maybe
Yeah.
certain geographies you like better.
Yeah, I mean, just like when you're looking at any type of real estate, the market's the most important part, right? We want to know that it's a growing market, that people are moving there, not moving out. We want to know that there's a diversity of employment base. There's a reason why people are living there. There's jobs, there's opportunity, and so like the first and foremost, like the market sucks, like we just don't even consider it, and that's pretty much applicable to even mobile home parks, right? Like I always joke and say, like, you can buy the prettiest mobile home park that's gorgeous, great entry, well maintained, but if it's in a crappy market where the schools are bad and people are moving away from and the jobs are moving out of country or relocating somewhere else, I can't fight that. I can't beat that battle. I can't win that battle, right? I can't force people to want to live there. And so the market's the most important. I could pick a really ugly property, but it's in a great market, and I can put money into that ugly property, clean it up, upgrade the infrastructure. And I know that just based on the market, I'll be able to attract the people there. They'll come in droves when I make it nice. And so anyway, so the market's first and foremost. And outside of that, you'd asked or you had made mention of, like, we're pretty particular. Like our buy box for parking it's very particular in that a lot of parking historically things that have parking that's been built over the last, call it 5 decades. Um, a lot of it, the majority of it, was built to support office buildings, right? If we're talking like urban core environments, locations, a lot of parking was there to support, the majority was support office buildings. And again, there's ancillary type of uses. There might be sports venues, museums, government buildings, hotels, things like that. But most of the stuff that was built was there to support the office that was surrounding either one office or multiple offices. And so the office dilemma is unique. There's phenomenally located office buildings in some of the best markets in the country that you could pick up for next to nothing right now that have major vacancy issues. And I don't know how to fix that. I don't know how to fix that problem. And so I would say that out of 50 parking garages that we look at, or just parking opportunities, it doesn't have to be a garage, it could be a surface lot. 48 or 49 of them probably don't fit our buy box because the majority of the demand driver was from office, and that office has gone away. Maybe not completely, but I don't know how to ever get it back to what numbers might have looked like 10 years ago. Definitely not pre-COVID or even because office was already in decline, and COVID was just a nail in the coffin, right? And so for us, it's got to be a downtown area that's very diverse in nature. And so while I'm okay with office being a portion of the parking demand drivers, we've got to have a fairly broad, balanced slew of other parking demand drivers. So government's huge. So courthouses, other type of government buildings, sports venues, NFL stadiums, NBA stadiums, baseball stadiums, all that kind of stuff. Music venues, museums, hotels. It's got to be a 24/7 city, meaning that people are not just there Monday through Friday, 9 to 5, but they're there in the evenings during the week, but also on the weekends, right? There's festivals, there's nightlife, there's bars, restaurants, what have you. And so office can be in that mix, but office has got to make up a very, very small portion of that mix. It can't be the majority, right? Because all the other ones are great. All the other ones are strong. And if if one drops down a little bit, I know that I've got all these other ones that are moving and they're moving and grooving, and they're more than likely not going to go anywhere anytime soon. And so for that reason, a lot of what we looked at, a lot of the opportunities that come across our desk, while they're in great locations, the parking demand drivers isn't diverse enough. And so we pass. And so that's first and foremost for us. Like, and so it's probably why we own 5 parking assets today. They're all fairly big in size as far as, overall value, but we've looked at hundreds over the years in order to find those 5, and all 5 that we own are incredible locations, and they've got a wide swath of demand drivers that support them. And office is some of it, but it's a minority piece of it. So I'll stop there just to see if you have any clarifying questions.
Yeah. So who are the typical owners? I think you've mentioned there's
Yeah.
government entities or cities are usually owners, and then corporate or investors like you.
Yeah.
What's that dynamic look like?
It's really both. I mean, any city you go to, you're going to find municipal owned garages and lots. At least most cities that you go to throughout the country, there's most cities have parking divisions, especially larger cities. They have municipal parking divisions, and they own and manage lots. And then you'll find the other side of the spectrum, which is privately owned garages. Some of it might be owned by big institutional groups that own a bunch of office buildings, and they just happen, like I said, by default own garages. And you'll find a few that are just people like us. Just it might be a family that's owned some parking assets for the last 50 years inside these respective cities. But most of it is like the mom and pop stuff. And I don't want to call them mom and pop because some of these groups are like they're families that are worth a lot of money. They're just they kind of invest in their city. They might be a Cincinnati family and they just owned a bunch of real estate in Cincinnati, and four of the pieces of real estate just happen to be parking garages, right? And they've owned it for 40 or 50 years. But those are where the opportunities lie because a lot of those families, they've owned it for so long, their basis is so low. They haven't adopted new technology. They still got the arm that's been broken, going up and down for the last 12, 15 years. They haven't adjusted their prices because it just doesn't make a difference to them. If they charge another dollar per hour, sure, it's going to drive additional revenue, but like it's not going to change their lifestyle, right? It's kind of the same thing when you start looking at legacy multifamily owners, right? They haven't done rent increases for a long time, or legacy mobile home park owners. They haven't kept up with the trends because they just don't have to, right? Like they have so much money, they have such a low basis, they make so much cash flow that their lifestyle is just it's not going to change if they bump the rents by 5% or 10% or what have you. And so those are the ones that we are really looking for, are assets just like that. But I would say that the couple most recent assets that we've acquired have actually been unique in that they're institutional sellers. And the one that we just bought in Philly, we're under a confidentiality agreement, even though we closed on it, about who the seller was. They're a huge group. And basically that became available. That became an opportunity. Same as the one that we closed in Charlotte at the end of last year. Both of these were owned by big groups. They just had the garages were standalone on their own parcel ID. They just happened to be associated with office property that was cross collateralized and ultimately, fell below the DSCR and fell into default and had no plan or no strategy to get out of it. And ultimately, were taken back to the bank or in special servicing. Both locations happened, but that gave us the opportunity to get in, be the knight in shining armor. The parking has been great. It's been operating flawlessly, even with the office struggle. And we were to come in and be the knight in shining armor and basically buy these things below replacement cost with in-place cash flows, again, phenomenal locations, and help them lower their basis, right? Help them recoup some of their capital and strip it away from the virus, which is the office building. So I think that's where the biggest opportunity is. That's what we're really excited about. We've got a number of deals that are in the pipeline right now that are just that. They're incredible locations, but they are not attached to an office, but they're tied into an institutional portfolio of office. And the portfolio is getting its ass kicked. And we're showing an opportunity and a clear path of how they can essentially help the claw back, help to kind of climb that ladder a little bit and lower their basis and find a pathway maybe to maybe break even instead of losing tens of millions of dollars. So super excited about that opportunity there. But to answer your original question, the ownership base is very diverse. Municipalities, I would say probably municipalities, if I had to make a guess, they probably own 30%, if not even more than that, of all the parking throughout the country. It's pretty big. And there's certain cities where they own a ton. There's certain, like you go to like Detroit or LA, they have a huge parking division, but there's sometimes even opportunity there. I mean, we bought a garage a couple of years ago from where I'm located in Tampa Bay area, and we bought it from the city of Clearwater. They had built it it was a private public partnership. They had partnered with a local developer. They needed more dedicated parking on the beach. The parking supply is very constrained there. And so they partnered with the local developer to build this garage. Now it's been, I guess, about 8 or 9 years since they built it. And as most cities do, they're just bad business people. They made a bad deal with the developer. Like they shared the ownership, and the city literally never made a return on their money. The parking garage is phenomenal, but based on the developer structured a deal, a big win on their part. The city got the short end of the stick, and so they needed money. They needed liquidity for a new project, and they didn't have it for sale. But basically, we talked with them and got them comfortable with selling to us and going through that process. So we ended up picking up a phenomenal parking garage in a great location, only like 6 years old at the time. And we bought it from the city because sometimes they need money for other, like they're working on other projects. And if they're not making a return on a particular parking asset and you can show them a pathway to get liquidity out of it, there might be an opportunity there. So, and I've heard that happening in other cities across the country where a private buyer gets into a transaction and transacts with a municipality and purchases parking assets. So there could be an opportunity there as well.
Are you like, do you just have a network of municipal, like, I guess you would need to know a particular person inside multiple municipalities to pull off some sort of off-market deal like that?
Yeah, I would have to say that our relationship there that helped us get in front of the city was with a local parking management company that manages a lot of parking, in and around the beaches. And so they're the ones that kind of brought it to our attention. They were not looking to buy. The parking management company wasn't looking to buy, but they're always looking to expand their own management portfolio. And that was one asset they had not been able to get under management. It was managed by another company. And so basically, it's a win-win. Right? I say, hey, help us get in front of the city, the right people, the right officials. And if we get this thing to closing, I'll give you guys first crack at taking over the management contract on it. It's a big one. It's a huge management contract. So that's how that one came about. But it's just anything, as with anything else, it's all relationships, right? Like just as long as people know who you are, what you do, what you're looking for, and you're out there, not just with your own best interest in mind, but also with their best interest in mind and trying to provide value to them. And that's what this whole game's about, right? Just, being present, being in the moment, but also be willing to help others out. And, I want them to help them grow their business. They want to help grow my business because ultimately that could help them grow their business. And that's a win-win all the way around. So lots of our deals have been relationships like that. In fact, I would say that there's only one parking asset that we currently own that actually that went through a marketed process. Everything else has been not listed, not marketed, not really even for sale per se. So I think that's where the opportunity is. And I think that's the opportunity in any asset class, not just parking. I think if you can build the relationships, be known as the guy or the group that will close, that will transact, won't waste time. You're not going to retrade. You're not going to play games. You've got the expertise to make it a smooth transaction. That's it. I mean, you want to be the one that gets thought of first. Okay, hey, we're thinking about selling this. Who should we go talk to? Right? Who's the person that has the proven track record, can get the job done, get it done quietly, get it done seamlessly, right? And get us our money and not screw around and, not get us frustrated. So you want to be that guy.
Give us an idea of how do returns or pro formas compare to another asset class, right? So I'm thinking in my head, a typical deal is a 15 to 20% IRR with a 3 to 7 year hold and a 5 to 8% cash flow. Is that a similar type of setup here, or what does that look like?
Yeah, and I say it ranges. And so we buy, so I just to give you a better understanding of our structure. We don't do deal specific syndications, and we do everything in a fund structure. And so we typically will blend both income type properties that are already generating, strong returns right out of the gate. They have value add, but they're kicking butt right away, and they're not going to throw off 18% IRRs over a 5-year span. But we'll blend that with some growth opportunities. And so our current fund's a growth and income fund. And a lot of the growth opportunities for us come from the mobile home parks because we're taking something that's going to be a heavy lift. We're going to bring a bunch of brand new homes in. We're going to do major infrastructure upgrades and improvements. And as a result of that, we're able to, bring rents to the market. Sometimes that could be 20, 30, 35, 40%, sometimes even, lost lease recapture. And so that, but that takes years to do that, right? That's like, a lot of times our mobile home projects like that are like a 1 to 3 year project, whereas the parking stuff is generating cash flow day one. And so and then as far as the parking as well, it also depends on the market that it's in. I could give you an example, like the Philadelphia one that we just bought, like that is about as core as it gets. It doesn't get any more core than that. And so I would say historically institutions would be the buyer on that type of asset. They'd probably be looking for 10 to 11% IRRs, like really low threshold, but really low risk investment based on its location. On that particular one, over a 5-year horizon, we're going to be somewhere in like the 14 to 50% range. And then, cash on cash returns in the 7%, neighborhood, give or take. So definitely below 15% is most of the parking stuff we're doing. But again, we're buying in core locations, institutional grade stuff that I know that when the day comes when we go to trade that, which that's not really our intent, we're buy and hold. I know for a fact that the buyer that's in line to buy that's going to be an institutional group that is willing, their cost of capital is significantly less than retail groups like ours. Their threshold on IRR is, sometimes even in the single digits. It's not even double digits, right? And that they'll pay a premium for that asset. So the spread's still there. I don't have to generate a 20% IRR in order to make my money. I can make that same amount of spread and that same amount of value on the back end because my buyer is a much more premium, high profile buyer that's going to pay a premium for that product when that time comes.
So it sounds like not the huge equity growth play
No.
but maybe a more, I guess what I'm hearing from you is more conservative or risk adjusted return.
Very much a risk adjusted return. And I'd say as far as our fund projections, like we fall and we've got a track record to prove so with our last couple of funds. We end up falling somewhere in the 16 to 70% IRR range. When you blend all of it together, like we're somewhere in the 16 to 70% range, which is, I feel is pretty darn good.
I mean, that's pretty darn good. And you're on your fourth fund now. Have you had a fund go full cycle? Two?
Yeah, we've had our first two that have gone full cycle. Yeah. And they still own some assets, but we did full return of capital in both those funds. And we're on our way with the full return of capital and fund 3, and then still buying in fund 4. So, but yeah, no, we've gone full cycle, and not full cycle, depending how you define it. Because what we like to do, like in our historical legacy funds, those were structured slightly differently, but basically we got the return of capital in our first fund. I think that happened like 2.5 years. Second fund took like 3.5 years to get a full return of capital. And in both those, part of that strategy was to sell off some of the assets. And then we basically cherry picked the best, the cream of the crop of those funds. And then we, recapped them, put long-term agency debt in place. And so the investors in those two funds, there's, each of those funds still own 2 primo legacy properties that still kick off cash flow. So kind of an infinite cash on cash return at this point. And we make distributions out of the funds on a quarterly basis. We just recapped both of them like 3 years ago. So probably in another 6 years, 7 years, we'll do another recap and we'll send another, big slug of money back. But it's more of a set it and forget at this point in time with some high quality assets that we feel we're the best of the batch in each one of those respective funds.
That's awesome. I think one of the big things that comes to mind is this idea of, okay, right now in May of 2025, we are now seeing Tesla start doing autonomous cars in Austin. And I think Waymo has also been doing autonomous cars. And I've heard from other discussions you've had how you think about the future of these parking garages as autonomy takes hold. Could you share a little bit more of your take of how you see that playing out?
Yeah, absolutely. Well, I mean, I think to try to simplify it a little bit, even with autonomous cars and self-driving cars, let's look at probably the more relevant area to look is like just use a normal Tesla that's self-driving, right? Like no, but someone that car still has to physically park and has to stage itself. It has to be somewhere. Has to be parked somewhere. I think we're pretty far away, at least from it being efficient for folks to maybe travel to a city and then their car drive all the way back home and park in the garage until they need it again, right? So like cars are always going to have somewhere, at least for the foreseeable future, until they can float in the air, right? And or unless there's a centralized staging area like that's 5 miles away, that the city creates just for that purpose. Till all that happens, which I think we're pretty far away from, cars will still have to go somewhere. Like there will be efficiencies that are created with your car being able to come out of the garage and pick you up out front at the restaurant that's 2 blocks away, but the car's still going to have to be somewhere while you're waiting to finish your steak, right?
I'd argue that, not to,
please.
that cars are, Tesla's done this thing where you can say, hey, after you're done using your car, you put it up to the network and that car goes driving around to be a taxi for other people, so that now it's getting use out of somewhere and now it's sitting down. Like, how would that play out?
Yeah, and I think that, I mean, again, that's definitely, I think that's real, but that also be saying that every car that's in a parking garage is a Tesla, but then also every single one that would have been parked is driving around. Like the congestion, you wouldn't be able to actually have that many cars on the road at one time. So inevitably, there's going to be a proportionate share of cars that aren't in that fleet. and the majority are still going to be parked somewhere when they're not in use, right? So again,
Absolutely.
and maybe in 15 or 20 years from now, it's a completely different story. But so kind of the take we took, the lens that we take whenever we buy something, like we've got to look at the underlying. We look at the underlying real estate. Number one, we got to have a very strong comfortability that parking, the parking demand is going to be there for the next 10 years. So we underwrite over 10-year span, and we're very conservative in our approach. But second to that, equally as important, if not more important, is that underlying land. I want to know what the future land use is, and what's the opportunity down the road as far as air rights and future redevelopment. And I want to know that that piece of land carries an incredibly significant value, more than that of the actual improvements that are on the land. Because I know that if that's the case, and it's in a phenomenal location in a marketplace, they're not making more of that land. And most of these garages are on a big swath. I'm talking like an acre. We in downtown Phoenix, we own half a city block, which is literally like right in central downtown area. You can't replace it. You cannot go buy a half a city block anymore. It's not possible. And so I know, and I'm not a developer, so we don't underwrite this. We don't put metrics to it. But I know that in looking at the icing on the cake down the road, that there will be a higher and better use at some point in time, whether it's 10 years from now, 15 years from now, maybe even 20 years from now. Because I think there's certain markets where you like go to Texas and things like. I think there's certain markets where the autonomous vehicle adoption will be much slower than that of maybe a Portland, Oregon, or a Seattle, Washington, or a Los Angeles, right? Or New York. You pick your city. But second to that, so there's actually some unique test cases that have actually already played out. There's a few groups, larger parking management groups, that have taken, and they're not just in the case study phase or like the demo phase, but they basically have created kind of last mile for Uber Eats and DoorDash. And so they've taken a couple levels of garages that are, call it Midtown Manhattan, right? I'm just picking a random one. And they'll go put a little storage container that's a McDonald's, a Burger King, and Arby's, right? Like Taco Bell. They'll put all these, all these small versions of those fast food restaurants, Chipotle, and all those, and literally that would become just like last mile distribution centers, for Amazon deliveries, last mile distribution for DoorDash and for Uber Eats and the other various programs out there like that. And it's been incredibly successful. So it creates a faster delivery time, more efficiency for a driver, instead of having to go 4 blocks, which in Manhattan could mean like a half an hour, right? Like it's centrally located around the residential district, and they can just go in, grab it, and they're out. So there's some unique concepts like that have come about. There's even a few parking garage operators that have taken a level in more densely populated cities like a Manhattan, and they've created miniature self-storage on one of the entire levels that are for the for the residents that live in the immediate vicinity. So there's I think it all comes back to like just all real estate, location. If you've got such a phenomenal location that's surrounded by density, and it's on a place of irreplaceable real estate that literally you can't find anymore in that marketplace, I think there's always going to be another opportunity to make money whenever parking isn't the highest and best use. So that's kind of how we look at it. But again, it's got to make sense today as parking. We don't put on the, developer lens. We don't put on those, the rosy glasses of like, in 10 years, it's going to be this. It's like, okay, well, today it's this, and it makes a lot of sense as this today. And then when it doesn't make sense as this, we are very confident that it's going to make a lot more sense as something else. But parking is the lowest value use at the present time.
So this concept of highest and best use is a term I want to dig into here. When I think about you mentioning, okay, garages are not the highest and best use of the piece of land because maybe they're not as profitable as maybe like a massive high rise. Why are those not? I guess why are you not buying those and selling them or redeveloping them? Or, I mean, maybe it's not your skill set, but why is that not happening? Or maybe it is.
Well, when I say the highest and best use, I mean, the highest and best use today, we've deemed to be parking. So when we're buying an asset, like we deem that the highest and best use is parking at the present time. What I'm saying is 10 years, whether it be 5 years, 10 years, I know that parking, based on the location, based on the future land use of that property, based on a variety of other factors, that parking is the lowest. It's the lowest value that it will ever be over the next couple of decades. Like literally, it will be something else that will carry a much more higher perceived value than that of a park garage when parking is no longer relevant, whenever that might be. So that's I would not say that we've bought anything that would make sense to tear it down. And we're not developers anyway. So like that would not be our MO. That's not our business model, but we have nothing that we have acquired today would make sense to tear down day one because the value of the land exceeds, the combination of the land and the improvements and all the value from an income perspective that the garage is currently generating. I'm sure there could be opportunities out there like that where, like we talked about earlier, I think there's a lot of office buildings that are struggling that have dedicated parking to where, it doesn't have that diverse demand driver base that we look for, but they're in a phenomenal location. I think but the revenue's down. It's down a lot. I think in those situations, there will be an opportunity for a developer, right? Like, and I think that's what's going to happen. That's what's going to happen in a lot of these office buildings, right? Like the ones that can't be converted, that can't find a different use in their present state. It'll have to get to the point where someone could buy it where the basis is low enough to where they can truly justify knocking it down. And they're going to buy it for the value of the dirt, right? Like I think parking garages will fall into that camp, when they're, in a situation where a lot of the parking revenue came from office and that's just not recovering anytime soon. So I do think that, but that's not our game. And that's not our business model. I think I'll leave that for the professional developers and let them run that course. Cause again, now you got development risk and all those other things, which we can have a cash flowing asset for 10, 12, 15 years. It helps us offset a lot of that future development risk, even if we were just a JV with another developer and bring them into the equation. So again, it's something that we don't underwrite and that's kind of like down the road in the future, but we got to be comfortable that we've got a very clear 10-year span of parking demand based on the variety of factors that are surrounding the garage.
All right. So garages sound awesome. Sounds super intriguing to me. Lower risk, risk adjusted returns. I'm putting my LP hat on and I'm thinking, oh man, I want to go out there and buy or own parking garages, or I want to invest with a syndicator. Maybe I invest with Sunrise. Of getting into this asset class, what are the common gotchas or things that I, as an LP, might undervalue or don't think about as I might be venturing into this asset class?
Yeah, I think that's a tough question to answer from the perspective of just the asset class itself. I think it's, making that decision, having that conversation with an LP. It's more about the sponsor that they're looking at, right? And what that sponsor's track record is and what their expertise in the space is. Because I mean, at the end of the day, an LP could go read a book on parking investments. They can read white papers. They can listen to every podcast out there. But like, it's very difficult to ever gain a comfort level of expertise enough to where they can ask the truly the right questions and dissect an individual parking investment and identify what they would perceive to be red flags, right? Like, I know there's some people out there, maybe if they've worked in parking operations before, they'd be able to do that. But the average LP and that same thing is applicable to any other asset class, right? Unless they've got personal experience of owning maybe a self-storage or a multifamily, they're going to have a very difficult time really poking a lot of holes in the individual business model. Again, maybe they've got an analyst background. They can identify maybe some messed up formulas in the model or something like that. But business model itself, they're going to have a hard time. And so I think it's more, that's what it all ties back to the sponsor. What's their track record? How much capital they put in deals individually when they do it? Like how much, like forget about like the company balance sheet's important, right? But so is a personal balance sheet. Like who are the sponsors running the deals and what's their personal balance sheet look like? Like if things do go sideways, are they going to have the financial wherewithal to help participate in these capital calls if something were to happen, right? And so I think it's all about the jockey. You gotta understand who they are and their expertise and track record, and go meet with them. Like your gut's pretty smart. It really is. Go spend some time together. Go walk some projects together. Go on site to an investment opportunity if it's a garage or whatever type of property is, and spend a day with that sponsor and ask as many questions as you can think of. Use ChatGPT now and say, hey, what questions should I be asking to the sponsor to help me better understand if it's a good investment or not, right? Like now we've got this really intelligent thought partner, AI, that can really help guide some of these situations along and help us ask more intelligent, more targeted, more pointed, just better questions to help us educate ourselves as LPs. So again, I just don't think it's asset specific. I think it's sponsor specific. So I'd love to ask you that question. I mean, what like your perspective on that? Because that's a tough one to answer. But what are your thoughts?
I don't know if I have a good I'm new to this asset class, right? So I don't think
Well, not
I
parking. Forget about
really,
parking. I'm talking like it doesn't matter because I think asset class is irrelevant for the average LP because the average LP is just not going to have a deep level of expertise in any asset class. Like they might understand from a high 10,000 foot view, like the business model, but like I'm talking like really getting granular in nature. And you gain that over time. Like if you're an LP in a bunch of different deals and you're truly maybe you're an analyst by trade and you can dive truly into the financial numbers, understand what you're really looking at. But I think that's a small percentage of LPs. That's not me having a derogatory approach to it. It's just the truth of the matter, right? I mean,
yeah, no, I
I'm
think,
invested in a lot of different as an LP in a lot of different deals. I'm invested in some private equity business deals, and I mean, I understand the general cusp of the business, like things that are outside of real estate. Like real estate, I've been doing it long enough. Like I'm pretty good. Like I feel like I can make a good judgment call on both the real estate stuff as well as the sponsor. But in private equity deals, like business type transactions, man, I'm putting a lot of weight on the actual sponsor itself. And I understand the general premise of the business and I can ask questions based on the business model. But I sure as hell am not as qualified to poke holes. Um, Nor would I probably identify a lot of the red flags of the business model itself, like I might be able to see in real estate. So anyway, it's kind of back to your typical LP. I just don't think they're going to be able to really dissect an individual deal to, I don't know what advice to give to somebody aside from get really good about qualifying the sponsor, themselves.
yeah, I mean, I think having looked, so I worked at a venture capital firm called Techstars where we invested $150 million in over 500 companies over a period of 3 years. And I was the
Wow.
person that was deciding which companies to put capital into that after the overall strategy was set by the chief investment officer. And so I looked at thousands of deals and it's the
Mm-hmm.
same thing, it's in, although slightly different, like in venture capital, you're looking for the same thing. You're looking for the operator, like who are the founders, what are their like what have they done previously? Have they been in this niche for a long time, or is this like something completely new? And then the equivalent of traction. And in real estate, the traction is you're looking for how many, have they done a bunch of these deals on their own? How are those performing? Have any of them gone full cycle? And similarly, in the startup world, it's like, okay, how fast are they growing? Is typically what we're looking at. And I think the same thing, that one additional piece. So I just mentioned, quote unquote, the jockey or the operator or the founder. There's a similar thing that I think we look into is the market. So like macroeconomic factors in real estate. So our building starts down in multifamily, and as where are we on the supply versus the
Yeah.
demand part of the curve? You look for a similar thing in the startup world, is like, how big is this market? Where are we in on the trend line of that market? So if you're in that world, that might be a good comparison.
Yeah.
But a lot of the same things apply.
Yeah. No, good point.
So what I'd like to maybe ask is, when you think through your buy box today for these things,
Mhm.
is it more nuanced, or is it a smaller, more detailed buy box today than when you first started?
Um, uh, yeah, as far as parking, no. Mobile home parks, yes. And I think where it's really changed quite a bit is the quality of the deals. I was willing to do just about anything to get some traction and that also involved incredibly heavy lifts, maybe in some more tertiary markets that might have a higher perceived risk to us today. And so like we tend to steer clear of too many heavy lifts at one time. There's only so many resources we have internally. We've got a great team, but we start looking at, we take on 3 or 4 heavy lifts, and then another deal comes along, maybe even more stabilized, and now we have a hard time buying it because we're so entrenched in the shit show that's happening with the 4 heavy lifts. So we're very careful and critical about how big of a project it's going to be, and on top of that, factoring in concerns around seasonality, like in cold environments, like there's going to be certain months of the year we can't work. I mean, how deep we have to go in this turnaround. Are we replacing infrastructure? And so we'll still do all that stuff. I would say we're probably more in the light value add side than that of going in and completely revamping a mobile home park, like where we're replacing water lines, sewer lines, complete replacement of roads, bringing in 70 or 8% new home inventory, stripping out everything that's there. Whereas 10 years ago, I would have done that, day in, day out. And we did like that. And you can make a lot of money there, but there's also a lot of risk. There's time risk. There's unforeseen risk with what's below the ground that you can't get your eyes on, right? You can do as many inspections as you want, but it's always going to cost you more than what you anticipate. And then I think outside of that, where we've changed is just larger deals. It's when you start syndicating deals, it becomes a lot more difficult to split the pie. It takes just as many resources to go buy an 80 space park and to run an 80 space park as it does a 180 space park. And so, not that we still won't buy an 80 space park, but it better be really close to something that we already own or close to a portfolio that we own, so we can have some economies of scale and some efficiencies there from a management perspective. But we'll steer clear of typically anything under 100 spaces if it's nowhere near, what we currently own. And years past, we've owned things as small as maybe 30 sites or 40 sites, right? And we would look at everything probably 30 sites and larger we would look at. And today it's more, 100 sites and larger for the most part. What else? That's probably really it. Nothing much else has changed in our business. We still look for solid returns, solid risk adjusted returns. We still look for great markets that have a lot of growth. We want to be in the best school district in the area. We won't sacrifice there. Most of our communities are all age communities, meaning that there's families that live there. Even folks that need affordable housing want to send their kids to good public schools. They don't want to be on the wrong side of the tracks. And so we will not sacrifice. Like there's lots of major cities. I just looked at a park the other day that was in Louisville. And Louisville's great from a broad level perspective. It's great, but there's some not so desirable neighborhoods in Louisville, and this just happened to be kind of on the wrong side of the tracks. And literally the worst rated elementary and middle school in all of Louisville, high crime area. And one could probably argue that Louisville as a market is great, and we could probably maybe make money there, and because there's such a demand for housing in Louisville. I'm just not willing to take that risk. I can't change the surroundings. I can't change, the 5 blocks that surround it. I can't change the schools being horrific. And so for that reason, I'm probably not going to be able to attract the most desirable demographic. The people that do care about where their kids go to school, if they have an option and a choice, they're not going to live there, right? And those that do choose to live there probably are, not the best pick of the batch. So anyway, that's
yeah.
But outside of that, I mean, our business is pretty much the same today.
So one of the things I think about as an LP is, assuming many of the LPs listening to this are trying to get to know Sunrise Capital investors, decide like, is this an interesting niche? Is this an interesting operator that I'd like to work with? One of the things I go back and forth on is whether I invest in single asset or multi-asset operators. And you started with mobile home parks, and now you've added in garage. I'd love for you to maybe talk through how you made that decision, why, and maybe how LPs should think about that.
That's a great question. It's one I haven't been asked before, but it's a really good question. And I would say that we did not take that decision lightly, because I'm very much stay in my lane. Let's put the hours in to be an expert in our respective niche. And it was many difficult conversations, probably 3 years worth of research when we first found out about parking, to internalize the discussions, to go to national parking. There's a couple major associations that function in that industry. Go to those events, get to know people, try to understand the business model before we ever even dared step foot or put a toe in the business, right? And so we didn't take it lightly, and and we were weary, and we just didn't know we didn't know. And but we we bought the first one after it was just shy of 3 years of us actually diving into the niche. Bought the first one, and then took our time for the second. We bought basically one a year for the last 5 years, and so it's still been a slow and steady growth. But I would be weary if I'm an LP looking at groups that do a little bit of everything, or they were just buying mobile home parks 3 years ago. Now they just pivoted, and prior to mobile home parks, they were buying whatever the latest and greatest thing was, right? Like, it takes a lot of time and a lot of years and a lot of hours to really gain a deep understanding of any asset class. Like, you got to be in there, you got to be running stuff, you got to be around other operators that are doing it, so that you can determine best practices, right? And so, yeah, I don't know what to say other than like be wary of that. And there's some groups out there, like you and I know groups that are in 2 or 3 asset classes, and from the outside looking in, it looks like they've done a really good job. They've been doing it for maybe even decades, right? I was always aware of that, and we proceeded with caution. But I would say that I wouldn't foresee us, and don't hold me to this, but I wouldn't foresee us venturing down any other paths outside of what we're currently in. Like we've explored some development opportunities in mobile home parks. We've done some expansions in existing communities where we've just, bought some additional land and added on. We've been, tinkering with over the last couple of years of developing, because there's no new parks really being built. There's very few new parks that have come out of the ground in the past like 5 years. And so, but it's still mobile home parks. It's still the business model that we know. It's just starting from scratch than that of buying the existing park. But really outside of that, the business model is exactly the same. We still sell homes. We still, look for the same, tenant base. We still are the affordable housing option in the marketplace. But yeah, no, it's a great question. I can't believe no one else has ever asked me that, because to me, my argument and then, our push and pull internally with myself, my other principal was always that. And it's the reason that it took us so long to actually buy the first parking asset, because we're like, damn it, we don't know what we know. So we tried to, run SWOT analysis on, figuring out like, where's the strengths, where are the weaknesses, where's the opportunity, but also where's the threat, the big one, where's the threat, and not just the threat to the asset class itself, but to how could this potentially have an impact, to our existing operations and our focus, and, where the resources are being spent. So I'd say the one thing with parking that's actually been really helpful for us is that how we manage it. So we're vertically integrated with the mobile home parks, like I'd mentioned. So every time we buy another mobile home park, or maybe not every one, but every probably 2 parks, we have to hire more people, right? Like we got to have more staff to manage the stuff. Whereas the parking, being that there's some phenomenal parking management groups, that's all they do is manage. They've got big technology platforms. There's a couple of publicly traded ones as well. There's big local outfits, regional outfits, and national outfits. We've got a lot of flexibility, and we can get best in class. And there's enough competition in the major markets we're in where we can truly pick the cream of the crop and get someone that can manage the day-to-day way better than we ever could. They've got a better technology platform than what we could ever build internally, because they've got such a large scale to their organization. And so for that reason, basically, we've got in-house asset management. We've got a dedicated person. That's literally our asset manager, literally ran Sam Zell's equity office parking portion for like 15 years. The guy knows parking. He lives and breathes parking, literally thinks about it in his sleep. He's our asset manager, but that's all we have now. So when we go to buy another parking garage, we bought one yesterday, I didn't have to hire anyone else. I'll go buy another one. I still don't have to hire one. We could probably technically manage, probably, my guess would be probably 20 garages before we'd have to bring some support staff in for our asset manager that's in house. So
Yeah,
it gives us
maybe that you get like a mix in asset classes, mix types in the fund.
Yeah. Okay. So great. I'm sorry, I went off the rails a little bit. So yeah. So second to that, it's both this fund and our last fund were both a blend of parking and mobile home parks. Again, it's kind of the growth in income. They're both growth in income funds, and we look at parking stuff as it's a perfect income right away. It's generating income. We're not delaying gratification. We're not delaying distributions. It allows us to start paying distributions fairly immediately. Whereas a lot of the mobile home parks aren't necessarily that. There might be a loss of lease recapture or a value add component that just takes time to kind of work itself out. And then I think the other part of your question, you're talking about like maybe a fund versus that of a specific syndication, maybe as an LP, like trying to figure out, like, do I invest in a fund? Do I invest in a standalone deal? I don't think there's a right or wrong. I mean, I could make the argument both ways of why one's better than the other, right? Like a single deal, you can maybe better wrap your arms around it as an LP. Like you only talk about one deal. You can look at the economics of that deal, ask specific questions about that deal. Whereas in a fund, while they're like, none of our funds have ever been blind completely, meaning that when we launch it, we always have a couple seed deals that we can talk to that are truly in contract, that are far enough along to where we're going to buy them. They're going to be the first deals that go into the fund. A lot of our investors don't know what the 6th, 7th, 8th, 9th, 10th deal might look like in that fund. And so some investors might, find concern around that. But I think our track record has spoken for itself enough with our other funds. Like we base our buy box still very similar to what it's always been. And the argument I would make for a fund is that there's a lot more diversity of not just markets, but individual assets. As you and I both know, the one guarantee I can always give you is that a pro forma will never be right, ever.
Right.
It's either going to exceed expectations or it's going to miss expectations, right? And so I think the diverse nature of a fund gives a better risk profile to an LP than that of a individual deal. So again, that's I could argue it both ways, but like that's kind of how we think of it. And we've got assets in certain funds that have just blown it out of the park, and you've got others that are like, for whatever reason, not missing the mark completely, but like again, a pro forma is never right. You do your best. You do your best to set expectations and kind of map out a business plan, but it's never going to be right on the mark. It just never is.
Yeah. And the idea of having both parking and mobile home parks together is maybe parking gives you immediate cash flow
Yeah,
and that allows you to maybe give out distributions to your investors that give you the time to do the value add to grow in value while you're getting the income.
that's exactly right.
Yeah. Very helpful. Kevin, this has been incredible. Thank you for educating us on everything parking garages and how Sunrise does deals. Where can people learn more about you, your current fund offering, and anything else?
Yeah, no, I appreciate that, Pascal. Appreciate you having me on. If they want to learn about Sunrise and our current offering, you can go to investwithsunrise.com. We've got some webinars up there, but we also have a bunch of additional items. We put case studies up, pretty transparent with deals, things that we currently own, as well as things that we've gone full cycle on. So you can go learn quite a bit about our business model and what we've done historically. And then outside of that, I'm pretty active on LinkedIn and Instagram. And my last name is unique enough, Bupp, Bupp, that if you just type in Kevin Bupp on any of the social platforms, you'll track me down pretty quickly.
Love it. Thank you so much for sharing your insights and expertise with us today. I got a lot out of this conversation. For those of you who are listening, if you want access to more cash flowing real estate deals like those from Kevin, you can grab my free passive investing starter kit at passiveinvestingstarterkit.com. And it's one of the best ways to start seeing quality 506C opportunity land in your inbox. So with that, here on the Passive Income Playbook, part of the Best Ever CRE show, we drop new episodes every Thursday. So be sure to tune in each week for more real conversations, strategies, and stories to help you grow as a passive investor. If you enjoyed today's episode, as always, if you haven't already, please subscribe, leave us a review, and thanks for tuning in. We'll see you next week for another episode of the Passive Income Playbook.